Okay, guys, thank you all so much for joining tonight. I'm going to turn on my camera so you can see me at least. If you feel comfortable doing it, you can do so too. If you got some warrants or anything you don't want to be seen, that's okay too. All right. But we're going to go ahead and get started with our training tonight. We are going to talk not very much about charts, but we're all going to talk about money. Okay. Um, we are in the forex market. That's the reason we're all here. We are in the foreign exchange market, which is the trading of currencies. Okay. So in the trading of currencies, we deal with money. And so we are not the major movers of the market, guys. The banks are, the institutions are, insurance companies, hedge funds, uh, investment banks. They are the ones that move the market. We don't move the market. Okay. So we have to find out what they are doing, how they are doing it, and we need to do it when they are doing it so that we can benefit from the moves that they make. Okay. That's what this is all about. Benefiting from the moves that the banks make. Okay. We don't want to trade like the herd or the retailers trade. We want to trade like the banks do. And when we do, we find easy entry, we find easy pips, and we can be profitable. Okay. So we're going to talk about money management tonight. Okay. And this may be a little bit of review for people that were the early students, but I have some additional material that I want to cover and that I want to get recorded so that we can have this memorialized. Okay. And so we're going to talk about, but before we get started, I want to go over um, our rules as it pertains to uh, our strategy. Okay. I'm going to get this memorialized as well. We look for 7 areas of agreement. Now we are using the simplicity system. Okay. I will tell you this, the trend period that we're setting it to is to 13. Okay. So for those that are taking notes, we're setting that to 13. Okay. This strategy is based upon higher time frame confluence. Okay. Now confluence is a fancy word for agreement. That's the reason I put 7 areas of agreement. Okay. So what we look for a rejection of a higher time frame structure. Now, the bread and butter one that we teach and we talk about is the 415. 415 meaning 4-hour rejection, go to the 15-minute and we take entry, okay? And we benefit from the rejection of the 4-hour for the 15-minute, okay? But notice I left that ambiguous. I say rejection of higher time frame structure, okay? Because once you get this, the concept of this strategy, it can be a 415, it can be a 1 hour, 30-minute, it can be a 30-minute, 5-minute, it can be a daily hour. The principle is still the same, guys. So that's the reason I'm talking about it in very general, ambiguous terms. Okay. And so so number 2 is we want to see a simplicity arrow on the local time frame. The local time frame is the lower time frame to which you plan on taking entry on. So again, 4-hour rejection, 15-minute entry. 15-minute equals the local time frame. Okay. Now, on the trend surfers, and we all are familiar with simplicity with the trend surfers. The little thing that's red is a little thin one and is a thick one. The short term and the long term trend surfers need to be in the same color of the desired direction. So if you have a simplicity arrow that's going down, you need to see red short term, red long term on the trend surfer. Okay. Also, the oscillator to which I have added to this algorithm, and if you don't have it, somebody please let me know in the chat and we can get together and get that to you. It needs to have broken the zero line. You know, oscillator goes up and down. It needs to have broken the zero line, and it needs to be the color of matching the desired direction that you want to trade. So in this instance, we got a down arrow, simplicity arrow. We need 2 red trend surfers, the short term and the long term being red, and we need the oscillator having broken the zero line and being red also. Okay, so you also we need color matching. Okay, the momentum line. For those that use the momentum, some people do, some people don't. The momentum line needs to be going in the same desired direction. If again, down arrow, red, 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 momentum line pointing down. Y'all see how everything needs to be like a choir. We need to be singing the same notes, okay? Now, the algorithmic trend line, that is the smiley face trend line for simplicity, okay? It also needs to be matching the same color. So in this bearish example, down rejection of structure. So we need to see an arrow pointing down from our structure, our pivot indicator pointing down, simplicity arrow pointing down, short-term and long-term trend surfers, red, signifying going down, oscillator broken a zero line, going into the color of red, which signifies for down, momentum line going down, algorithmic trend line needs to be red, meaning that it's the desired direction of going down. And then the last thing is the algorithmic trend line has crossed the 50 smooth moving average going down. Notice how everything has in common, guys, going down, or a color that signifies going down, okay? So I want to explain that, and we'll show it on the chart in just a second, okay? The other thing is, before we trade, checklist, and these are the things that I always do before I start trading. I try to always do, okay? But have we done an emotion check? Are we happy? Are we sad? We don't want to use trading as therapy. We don't want to be trading when we're upset with our significant other, when we're feeling anxious. We don't want to trade emotional. We want to be just very even keel, okay? Have you checked your internet connection? There's nothing worse than getting in a trade and then everything goes dark on you and you don't know where your trade is, okay? Have you checked market conditions? Is the market choppy? Is it flat? Is it smooth? That matters, okay? Have you checked your broker spreads, okay? There are times in the market where the spreads are extremely wide. So if you get into a trade and normally the spread is only 2 pips, and if something's going on and it's a 12 pip spread, you already start very much down in your trade, okay? You check for spreads. And have you checked for upcoming news events? There is nothing that will mess up a trade more and sometimes bless you more, but you just don't know, than a news event, okay? So my rule for trading is we don't trade before 30 minutes before news or 30 minutes after, okay? We allow everything to settle down, and then we jump in, okay? So 30 minutes before, 30 minutes after is kind of a no trade zone, okay? So tonight we're going to talk about risk management, okay? So I want to talk about risk management rules as it pertains to how I teach my system of trading, okay? For me, I don't trade any more than 1% of my account balance. I want you all to definitely hear me and hear me well. We only trade 1% of our account balance on any single trade, okay? Example, if I trade GBP USD, I'm only trading 1% of my account balance, okay? Reason being, guys, the reason a lot of people get in trouble, and the reason a lot of people have not been successful, even with simplicity, as good as it is that they're putting too much percentage on their trades. And as a result, they're over leveraged and they can't handle any kind of drawdown because they get so emotionally out of whack. Because when people get in trades, they only think about, oh boy, this is going to go way into profit. I'm going way into profit. And MT4, we know, you can drag that line, the little line, you go down to profit. You can drag it all the way down to say 1,500, right? We get excited about that, but when we go up there, like, oh, I don't want to lose that much, okay? So we only want to put 1% at risk, okay? If you put 1% at risk, guys, you have to lose 99 trades in a row to blow your account. I want y'all to think about that. If you lose one trade, you still have 99% of your balance. If you lose 3 trades, you still have 97% of your balance left, okay? Now, if you lose 99 times in a row, you don't need to be trading. You need to find another hobby, something else, do drop shipping or something else for extra money. You don't need to be trading. If with this system, If you follow the rules, you should not lose 99 times in a row. Okay. So that's to make sure, because if we don't have money, we can't be in the game. Okay. If we don't have capital, we can't be in the market to try to even benefit from the market. So 1% risk. Okay. Now, in addition to that, no more than 3% of your account balance can be at risk in all cumulative trades. Let me explain this. I got it broken down right here. Let's say you see a good setup here, you see a good setup here for 15, you see a good setup here, okay? This is your max, okay? You can break that down in 0.5%. I don't care how you break down to 3%, okay? Today I got in, I think it was Euro AUD. I got in a second position, and I think I documented that in our on the Telegram. So I had 2% in one trade, but there were two separate positions that I took. I hope that makes sense. Okay. And so I didn't take any more, but if I saw something else that I wanted to get into, I only could risk 1 more percent. It depends on how you risk that 1%. So you can risk that 1% over 6 positions, whatever way, whatever is your fancy. Okay. And the reason being is I'm trying to condition everybody for qualifying and being and staying a qualified trader for to be a prop firm funded trader. Okay. Funded prop trading firms, they have very tight rules. Okay. One of their rules is you cannot lose more than 5% of the account balance in one trading day. Okay. That doesn't sound like a lot, but if we're risking 4% on every trade, let's say you lose that trade, you only got 1% left before you've lost the privileges to trade with their money. Okay. And so I'm trying to condition us that if we only risk 1% at a time, if I lose that, I'm not risk of losing my privilege to trade a prop firm trading money, to which I can benefit from an 80% commission. Anything I win for them, I get 80% of the profit. Okay. That's an enormously great deal, guys. And we don't want to disqualify ourselves from qualifying, or once we qualify, you can lose your privilege to trade with the funds if you if you violate that rule. Okay. So if we've got if we got a max of 3 trades or 3% exposure, even if we lose all 3, I would suggest stop for the day. But guess what? You still have a 2% buffer and you haven't disqualified yourself. Okay. So that's the reason we do what we do. I want to give y'all a little, that's down the road. We're going to talk about qualifying for prop trading firms and becoming a funded trader. That's going to be down the road. But I wanted to give you the method to the madness, that if we build our muscle memory to only trade 1% at a time, we will never be in danger of violating that rule. Okay. So that's how that goes. So the next thing we want to get to, knowing that we're only risking 1%, let's just go through the scenario that we're only risking 1% on a trade. That doesn't sound like a lot, right? You may say, hey, Tony, I can't make any money risking 1%. I got to go like 3% because the average, the average trader risks, 2-3%. But I'm going to show you how you can benefit from 1%. Okay. Now, I will say the traditional way to which simplicity is traded and how it's taught, it is very hard risking 1% to make any substantial gains. Okay. I understand that. But this is the way we're going to do it. Okay. So I'm going to describe a scenario. And if this is you or has been you in the past, I want you to type a 8 in the chat. I'm gonna tell on myself. When I first started trading, I used to look at a good setup. Man, that looks good. I see the arrow come in. I see the green. I see the red. I see all green. Everything's matching up. Man, I'm jumping on this. I'm jumping in this thing with $1.50 lot. $1.50 lot on GU. That's $15 a pip. And man, this thing like, I look down to the bottom of the box. oh shoot, this thing gonna run 50 pips. So I started doing my math. Oh, 50 pips times $15. Like, oh man, bro, this is gonna be some good money, right? So I get in it. I'm confident. Well, then I got to put. Then next thing I do is I take you hit that green line on MT4 and you drag it down, and that thing tells you, oh boy, you're gonna make $5,000 on this trade. Oh boy, it's good. So then I hit the same green line and I drag it up above the box, like Simplicity tells you to do, and find out, oh my goodness, that stop loss is 45 pips. You mean to tell me I got $3,500 at risk? Oh no, I can't do that. I'm gonna bring it down right here. I'll risk 800. And so what you end up doing, you're letting the amount you stand to lose or gain drive your decision making. And what you end up doing, you put your stop loss so low, not because that's the safest place, but you put your stop loss low because that's a tolerable amount of money for you to lose. If anybody's done that, put an 8 in the chat. David, thank you, sir. Okay. Anybody else? I'm gonna tell y'all, that's me. That is me. I have done that. That is trading backwards, y'all. That is dangerous. Because what we're doing, we are letting our greed and our fear determine our lot size. Okay. When, let me tell you, these institutions and these banks, they trade unemotional. They trade like robots. They trade consistently, and they trade already knowing that they're going to lose sometimes. But the risk management is such that mathematics favors them always winning. Okay. And so that's what I'm about to show you guys. Right. So here are our rules on how we determine our lot size. Okay. First of all, we're going to determine our percentage of risk. Okay. We've already determined that, right? Our percentage of risk is 1%. Okay. So we've already got that established. Okay. Next, what we have to do, we have to determine what our stop loss is. All right. Once we determine what our stop loss is, then we have to determine what our take profit is. And I'm going to show you this on the charts. Sorry about that, y'all. So after I do determine the stop loss, then I determine what my take profit is. Okay. So let's go to the charts and let's look at an example of this. Okay. And I'm going to switch over. Sorry, guys. I connect via VPS. There we go. Okay. So let's say, let me find something that ran today. Did anybody take that trade with me today? Euro AUD? If you did, put a 5 in the chat. Okay. So this is the trade that I took today. Okay. Now I entered on the 5 minute because I was confident that drop that was coming. Okay. All right. So this is the 5 minute. as it came in, this is where I entered here. All right. I entered here. I put my stop above this level of structure up here. Okay. As you can see, that was about 15. It's about 16 pips. Okay. I determined that I wanted my my take profit to be here, 40 pips. So y'all remember that. Okay. 16 pips, stop loss, 40 pip take profit. I figured, I was like, you know what, this thing is going to go to the top of this box. I feel fairly certain about it. All right. So this is what I then did. Okay. So remember 16 and 40. All right. I then go to Nash Markets calculator. Okay. Go to the Nash Markets calculator. And I'm just putting numbers in. Okay. $10,000. So what I do, I tell the calculator, this is my starting balance. Okay. I tell the calculator how much I want to risk of this 10,000. Y'all see it automatically populated to 100. Okay. I then have to tell it I want to trade the asset of Forex. I also tell it the instrument that I want to trade, the pair that I want to trade. So I traded Euro AUD. I also told the calculator, which way do you want to trade in? As you see it, put an entry price here. Tell them I want to trade short, meaning I want to sell. All right. And y'all remember those two numbers we put in, right? We measured. Then it's going to ask you, well, how big is your stop loss? I told it 16 pips. And I put 40 pip target. Y'all see how organized that this makes you when you trade. Okay. I'm going to review everything that I just put in. Put in my starting balance. Put in my percent of risk. That populated that automatically. So, okay, I'll do that math for you. I want to trade the asset class of Forex, and I want to trade this particular instrument. It then gave me an entry price, and I told them what else I want to do. I want to short it, meaning I want to sell, and I already have my stop loss, and I already have my take profit. This is the information I put into this calculator. And then I simply press this. And I'm going to enlarge this so we can see this for the benefit of everybody. The calculator, without any emotion, it doesn't care about what's going on. It told me this is the lot size that you need to use based upon the information that I put in. Okay. It also tells me this is your risk to reward ratio, meaning 2.5, you stand to gain 2.5 times what you risk. That's what risk to reward ratio means. Okay. In addition to that, it gives me this based upon what you told me. This would be the entry price, which can change. This would be your stop loss, meaning you're only risking $100, and this would be your take profit, saying this is what you stand to gain. When we get this information, y'all, we can go to we can go to the market and trade with confidence because we know what we're losing, we know what we're risking, and we know we've done our analysis, and we take our trade and we live with the results. Okay. So that's how we come to the market unemotional. We come with facts, we come with figures, we come with statistics. And when we do all of that, now we position ourselves to be profitable in the markets. Okay. Now, here's a great thing I want to share with you. In addition to this right here. So let's review this. We determine our percent of risk. We know that our percent of risk is 1%. We determine our stop loss. We determine our stop loss was 16 pips. We determine our take profit. We determined that was 40 pips. We enter that information to the calculator. We enter the trade with the lot size. Let me fix that. The lot size given by the risk management calculator. Nothing more, nothing less. That is that. This thing will tell you to the penny what your risk is going to be. Okay. Now, here's the part that the last thing I want to share with you guys. Our minimum risk. Our minimum risk to reward ratio that we want to take is 2 to 1. Okay. Our minimum risk that we want to take is 2 to 1 risk to reward. Okay. Now, I know this is messing with some of the stuff you've heard. The simplicity they teach to go for a one to one. Okay. I understand it. I'm not going to say it's wrong. I'm just saying there is more than one way to skin a cat. And the way that this strategy that I've put together is it allows you to get higher risk to reward ratios by virtue of reducing your stop loss. And I'm going to show you how, okay? As you all know, anybody that's been with Simplicity any amount of time, we know that what is traditionally taught is we get in when all things line up and we put our stop loss 10 pips above the box. If anybody's ever heard that, put a 3 in the chat for me, please. Okay. 10 pips above. Now, am I ever going to say that's wrong? No, that is not wrong. Okay. And as you can see, it never hit the stop loss, right? So I'm never going to say it's wrong. It's right. It is the ultra most safe way to make sure that, you know, you can stay in the trade, you don't get hit. However, look, the way that the strategy is that we formulated, when you get in at the optimum time. Okay, now this one, it was a little unorthodox today. That's the reason I got in on the 5 minute. All right, but let's look here. Well, let's just say this right here is the entry. I got in on 5 minutes, so I was already in right here, but this would have been the optimum entry right there. Okay, when that line crossed that. So given right here, if you to measure here just to up above here, we're talking about 26 pips. Okay, versus taking it all the way up here for a 50 pip stop. So let me give the same. I'm going to give you guys the same information. Remember, we just put in this calculator 16 pips and 40 pips, and the thing told us 0.84, right? Was the lot size that we could put in. I'm going to put 50 pips in the place. I'm going to put 50 pips in the place of what used to be 16 pips. Okay, let's see what the calculator tells us. I don't know what it's going to tell us. I'm finding out same time. Look at this, guys. 0.27. Remember before we could get in for a 0.84? Now we're getting in at 0.27. Look at this. Our risk to reward ratio is negative 0.8, meaning we're risking more than we stand to get. Okay. Now everything won't be this extreme, but this is less than 1-to-1. And so it's telling me, hey, if it hits your stop loss, you're gonna lose 100. But if you hit your take profit, you're gonna make 80. This is not a good trade, guys. And so the reason we try to find the safest, the reason we try to find the safest and closest entry is because as we approach the market and trading, we're only going to trade 1%. The question is that 1% going to be 0.84 or is going to be 0.27? Notice the calculator didn't care. It didn't care about, it said, just give me the numbers and I'm going to spit out what you need to do. Okay. And this is the beauty of this particular trading strategy, guys. When we wait to the last possible minute to when price is going to break out and keep going. This was Friday. This is a beautiful example of GU on Friday. This is where everything crossed, everything lined up, red, 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 breaking of structure. Look how tight the stop loss was that I was able to use. I rounded up this a 15 pip stop loss. Okay, 15 pip stop loss, and it ran down to the bottom down here. 53 pips. Okay, that was almost that was almost a 4-to-1 ratio. Okay, as a result, I can get more lot size out of my 1%. Okay, if that makes sense, guys, can y'all put a 7 in the chat? If that makes sense. The reason we try to go for the safest and the smallest stop loss, we're not doing like I used to trade. I'm not putting a short stop loss just because I want a short stop loss. I'm doing it because I waited to the last possible moment and now price is broken out and will not come back again. I can safely put it up here. I can put that information in the calculator and say, oh man, you can get $1 lot. You can get $1.20 lot. And now I'm making more per pip for a shorter run. It only ran like 50 pips. But if I got $1 lot on those 50 pips, that's $500 versus if I would have gotten in right here, same spot, taking it up here. Look at this lot size, guys, 35 pips. So it probably would have told me you can get in on maybe a 22 or 20 cent lot. Well, 20 cent lot is $2 a pip. Well, $2 a pip times these 53, that's $106. I'm not saying I'm not grateful, but if I just waited to the optimum place of entry, okay? If I wait to the optimum place of entry, I get a shorter stop loss. Shorter stop loss rewards me and allows me to use my 1% in a more wide way. And now I can benefit from these smaller moves. In order to get the equivalent of what this stop loss would have given you, I would have had to stay in all the way down here. And look what you would have had to endure. It went down 50. It went up 30. Went down more, 30. Went up more, almost 50. Went down some, 50. Went up 30. Went down 40. Y'all, you're going to get seasick riding with all that. I am a believer of this. I explained this scenario to somebody, and then I'm gonna be done, guys. And I think we was talking in our pop-up session last night. One of the reasons that when you shoot someone, and excuse the graphic description, one of the reasons you can use the most damage to somebody is one of two things. If you have a sawed off like shotgun, or if you shoot somebody point blank range, that causes the most damage. Why does that cause the most damage? Somebody describe that for me. Can somebody put that in the chat why that causes the most damage? Somebody who didn't hear it last night. Anybody? Anybody got an answer? Anybody know? Got a new message. Oh, Dave, yeah, you were on last night. Okay. More power. Exactly. Exactly, Dwayne. More power. Okay. Now I'm going to change the word, exchange the word power for velocity. Okay. Reason people saw off the barrel off a shotgun is because the longer it goes through that barrel, the more velocity it loses along the way. It's just plain physics. Okay. Or if you shoot somebody point blank, the strongest momentum of that bullet is when it immediately comes out of the barrel. Okay, y'all stay with me, follow me. This right here, this is hold on, let me slide over. Do you see this direct falling of price? This is like a bullet coming out of the chamber. Okay, now let's look on the other side. The other side of that is the further the bullet gets away from when it was initially shot, the less momentum the bullet has, and it gets a little flaky. You see that? Yeah, do y'all see that? If y'all see that, type of 2 in the box, please. Okay. Look at this direct movement. And then look at how unstable it gets. It gives you 30, takes away 40, blah, blah, blah. Here's what we can catch this every day. We can catch this, we can catch the bullet coming out of the chamber. Okay. It can be quick, it can be direct, we can catch our pips and we can get out of the market. I'm telling you, this happened right here. This happened about 9:30 when New York Stock Exchange opened. And if y'all follow my chat this morning in the Telegram, I told anybody who's in that trade, we're going to start taking our position, at least 75% of our position at 10:30. Why? Because of the ocean wave theory, like Uncle P teaches, that London starts closing and they start taking their profits for the day. So any profit you've gotten, and I don't know if y'all have been there, somebody put a 9 in the chat if you've been happy with your profit, and then 10:30, 11 o'clock hits, and then it starts going the other way. I've been there. I have been there. Okay. So what we start doing, we benefit from the volume and the velocity of that bullet coming out the chamber, knowing that the further it gets away from the gun, it's going to start getting erratic. And y'all see what happens right here. Okay. And it happens all the time. Watch, I'm gonna find the one right here. Let me zoom out a bit. Look, when it breaks through, look how direct it is. Bullet coming out of the chamber. Boom. And all of a sudden, when London starts closing, what it started doing. Okay. This is the most, this zone right here. I'm trying to get my annotation up. This zone right here is what we want to catch on every 415. Y'all, and we can find it every day. Okay. And I didn't get in here to show y'all that, but I want y'all to understand. And that's the reason, if you look right here, look at this short stop loss. It broke right there. That would have been your entry. Okay. That would have been your entry. Stop loss, 33 pips, but it ran 87 pips. That is almost a 3-to-1 trade, guys. And that's the reason we wait for the latest possible moment when it is about to break out. We put it behind the closest area of structure rather than putting it back here, so we can maximize our lot size by having a shorter stop loss. And that's what I mean by a shorter stop loss and a safe stop loss. Would you have been wrong to put it back here? No, you would not have, but you would not have been able to benefit from, you would have had to stay into the move here. Now, did it go? Yeah, it ended up going. It ended up going, 200 pips. But if I got the right lot size, I can benefit from the same move here that would have taken almost 2 days to get up here. And this is what we want, guys. We want the direct bullet coming out of the chamber, okay? And so that's the reason we look for a minimum of 2-to-1 risk to reward, okay? All right. So this is the last thing I want to show you guys why we go for a minimum of 2-to-1 risk to reward, okay? And I'm gonna share this, the last thing I'm gonna share with you. Look at this. This is a risk to reward win percentage to break even, okay? This is all math, guys. So I'm going to start here. I'm going to start here with 1-to-1. Okay. If we always trade 1-to-1, in order to break even, we have to win at least 50% of the time. That's just to break even. I mean, walking in place, spinning your wheels. I've been there. But look at, if you simply go to 2-to-1. Your win percentage only has to be 33% to break even, y'all. Meaning you can lose 77% of your trades and still break even. And that's pretty bad at trading. You see what I'm saying? You literally can lose almost 7 out of 10 trades and still be break even. This is math, y'all. Look at, if you do a 3-to-1 trade, y'all, you can lose 75% of your trades and still have all your money. Literally, you can lose almost 8 out of 10 trades. So that's the reason we are going for not large stop losses, but large risk to reward ratios. And when we do that, look at this, guys. For every one you lose, you can lose 5 in a row. But if you win one of these, it will almost cover all your losses plus some. Okay. And the bigger, and this is the reason some people do swing trading. Because look at this. If you do a 5-to-1 trade, you literally, y'all, this I know this math is hard to fathom a little bit, but you literally can lose 83% of your trades and still break even. Now, I would dare say you need to go back to the drawing board. But if you use proper risk management, consistent with your lot size, consistent with your percentage risk, and let your lot size be determined by your stop loss, you can literally lose 83% of your trades. If you do 1-to-10, and this is like swing trading, this is large, you can lose 91% of your trades and still be break even, guys. And so I'm not going to belabor this point, but when I saw this, my jaw dropped, because I understood the premise, but to see it in those stark terms, it really opens your eyes and why it behooves us to be consistent with the amount that we risk, and let our lot size be determined by our stop loss and how we spread that risk out over the pips that we risk. Okay. So with that, guys, I'm done for tonight's lesson. I know it was a lot. Please go back and review this. And with that, I'm going to open up if anybody has any questions pertaining to what I covered tonight. I know some people may have some particular issues, and we'll go over that. But any questions about anything, if you would raise your hand, and I can I can, because it may be something that benefits the class tonight. It should be a raise your hand feature. Or if anybody wants to type something in. David Brown raised his hand. Yes, sir.
Yeah, Tony, how does the stop loss hunt play into that strategy? Because I know for the most part, you know, and I really like what I'm seeing tonight because it makes a lot more sense. And I even calculated on one of those, if we place the our stop loss up closer to where you said it, if we're going for 20 pips and we only get 10, we still make our goal. I don't know if you saw that. You know what I'm saying? Okay, I'm not hearing you back. So,
Oh, I'm unmuted now. You hear me?
oh, I hear you now. Yeah.
Okay, I had muted on my mic over here. So, yeah, let me go to chart to show you, Mr. David.
Yeah. Yeah. And the only thing my question was basically on the when they start doing the stop hunts.
Yes, sir.
Spike it up. How does what you're teaching play into that, or what's a kind of a safeguard against that?
Okay, great question. So I know many of you have been on Uncle P's. He'll be doing a session tomorrow morning. I'll be on that on Wednesday morning. And you know, he talks about he calibrated the system to which it filters out the noise. Y'all ever heard him say that before?
Yep.
And filtering out the noise, this is what you're trying to avoid. This right here, where it already hit twice up here. It hit 1, 2, 1, 2, 3, goes up 1, 2, goes up one more time, and then it keeps going down. Doing this, putting this algorithm that I kind of came up with, having all these areas of, having all these areas of confluence, along with this crossing over, this is extra filter. Essentially, this is the stop hunt. This push up here, all of these going up. See, when things go up and they push down and didn't really hit any real structure, it's really the bank trying to shake everybody off before it gives up money. And so, again, this is a industry and a game of probability, right? The probability is very low that when these two moving averages, okay, cross each other, the probability, and you all please go back and do back testing, okay? The probability is very low that once these cross, combined with volume, okay? And that's the other thing, and I may end up adding it as a rule, but when these two things cross with volume, because see, this happened at New York Stock Exchange Open. So there was enormous volume there, okay? Rarely, statistically, it is very rare that this is going to come back up and do something up here, unless there's a news event to which nobody can know that, prevent that, or whatever. Okay. So as a result, this is actually this is extra filter, even from what Uncle P's system does. And I'm going to go back here to this entry, because technically, this was not a bad entry based upon simplicity rules. Green, green, green. It was probably, if I highlighted, probably in the box at the time on the higher time frame. But look at what it did. Okay. Waiting to this moment when all these things line up is an extra filter. And so now we're able to get in tighter stop loss at the moment where volume is into the market. Okay. So that's essentially what the algorithm does, Mr. David. It just puts an extra layer, maybe two more filters. And the filters are this breaking of structure from this oscillator, this crossing of these moving averages. And to be honest with you, somebody who's ultra aggressive, they could actually put the stop loss underneath the structure of these two moving averages crossing.
With the crossers instead of at the support line.
Yes. Now that is ultra aggressive.
Ultra aggressive. Yeah. I was looking at that.
Right. I wouldn't recommend that at this juncture. Okay. This is sufficient. I consider it like this. I consider this 10 pips behind here ultra conservative. I consider this moderate. I consider that ultra aggressive.
Okay.
Okay. But just to answer your question in short, again, waiting for these areas of confluence to come together acts as an additional at least 2 filters that actually filters this out even more and gets you in the move sooner with volume. I hope that answers your question.
Oh, yes.
Okay.
Very much so.
Great.
I did have one more, but it'll come back to me. It'll come back. I'll let somebody else go.
Okay. No problem. No problem. Anybody else? Anybody else? Anything in the chat? Going once, twice, 3 times. Okay, guys. Well, I know this is a lot. Please go over this. I tried to be as concise as possible. It's a lot of information, a lot of good information. Digest it, write notes. Don't forget to you can message me. And I'll get back to you, as soon as I can, or direct you to some literature or something that will help you guys. But it is not complicated whatsoever. Okay. And I'm going to go ahead and end the record.